Richard, many thanks for your time. So that question, hawks or doves, as I say, the actions don't seem to match the words.
Well, the words are strong. I agree with that. I also agree with you. They're a little bit dovish in terms of actions. When they moved to 25-point moves last November, the first word that occurred to me was brave. The RBA showed a lot of bravery, I think we said at the time. They took a judgment that moving by a sequence of 25s, they'd be able to send a strong and elongated commitment to their efforts to bring inflation down. Look, I think moving by 50s would have sent a more powerful signal, and perhaps they would have been closer to the end of their tightening cycle than they are now.
So my observation here, notwithstanding the words, they're determined to keep raising rates. Isn't that death by 1,000 cuts to the Australian economy?
That's the risk, that by moving in small increments, it becomes more difficult to assess when, in fact, you're done. Just in my view, if they'd gone by 50s, they would have been able to take a clearer pause and perhaps have a clearer reassessment. Whereas now what we're looking at is what's inflation doing, what are wages doing, but also what's consumption doing.
Yeah, so we can see these rate moves, and you can see, as you point out, November was when they started. But that was sooner. That tapering was much sooner than other central banks around the world that were steadfast in trying to defeat the inflation, many of which have now got inflation rates lower than Australia.
Look, it's worth pointing out, looking at that chart, Reserve Bank of New Zealand went 75 in one meeting. It's taken the Reserve Bank 4 months really to deliver an equivalent hike. I think, not that I think the bank should have gone 75, but in one meeting, I think that sends a more powerful signal than stretching that over a period of time.
And then you start to see the cumulative effects of these, and even here versus the other parts of the world. You can see where our cash rate even sits now, well below those other parts of the world. You can see the inflation rates there on the top. The United States, cash rate 4.75% in the middle, and an inflation rate of 6.5% and coming down. So really the Reserve Bank is betting on its forecast that this is the peak of inflation, that they don't see this inflation staying higher for longer.
I agree, it is the peak of inflation. I think almost certainly the issue is the pace of decline. Other countries have had a bit of good news on that. Perhaps, as you say, because the RBA hasn't gone quite as aggressively, maybe Australia's a bit slower. Maybe the other wriggle to point out is some of those other economies have monthly inflation. Australia, we're not quite sure whether to trust that data yet. Yes. So the quarterly inflation numbers still have inflation higher. There's
one other aspect of it, and we started talking about this in the last couple of days. In the United States, you can see the household savings ratio coming close to zero, in many decades low there. Here, it's relatively high. The stock of savings in the community are still relatively high, which makes them immune from the price rises. This is what makes you wonder whether the inflation and, if you like, the consumption is really going to disappear as quickly as what the Reserve Bank might like.
Look, I think coming into this tightening period, there was a lot of suspicion about the sort of analysis which argued that the household sector was in good financial shape. People were quite worried. 300 basis points of rate hikes later, it seems very clear now the household sector's in quite good financial shape. Still no real signs of any sort of substantial stress in the household sector. Some weakness in retail spending, but spending on services still very strong. I think we do have a few more rate hikes to come.
OK, so then the big question is, how many more rate hikes do we have to have? Because, as I say, then you start to have that precarious situation where the last couple, where you're still trying to find out what's happening with household consumption, might be the very ones that start to tip the economy over.
Look, that's possible. I don't think we're still that close to a risk of a meaningful tip over. We need to see some slowdown. We need to see some pockets of spending certainly retrench more forcefully than we've seen. Our forecasts have another 50 points of rate hikes over the next 3 months. Look, that seems, if I chose that number today, that's what I'd do, because I think that fits with the idea we're getting close to the end. We're probably not quite there yet, though.
And there's anecdotal evidence of the declining inflation. We were talking to Anthony Scarley from Nick Scarley yesterday, who was telling us that the price of a container to bring it to Australia was $8,000, now $800. You can see it in fuel prices, for example. So there's evidence out there that there really is some deflation coming.
There is a little push me, pull you, though. Commodity prices, transport prices, shipping rates unambiguously come off quite a lot. That's helping. In the latest data we have for Australia, wage growth still picking up, unemployment still very, very low. So I suspect what you'll see is goods prices, that inflation rate in goods coming off, but in services probably remaining above what the Reserve Bank would like to see.
But hang on, what you've just told me then is that the baked-in inflation is becoming more real now. So we're having even a look here at the inflation forecasts that the Reserve Bank has got and really amended them a bit today. So they've increased the forecast for unemployment a little and for inflation a little compared with where they are. That means, you know, over the course of this year, that inflation rate at 4.75% has come off, but it hasn't disappeared back to that 2 to 3% band.
We're still double the Reserve Bank's target band.
Okay, the baked-in inflation, go back to that question because that's the other one that's absolute key to this. Because if the inflation becomes baked in, those interest rates stay higher for longer.
So maybe there's two issues. There's the baked in terms of expectations. There's baked in terms of second round effects in the economy. This inflation cycle started with first round impacts. There are some second round effects, but they're not at 7 or 8%. They're probably at 4 or something of that order. The bank needs to bring those down a little bit further, I think. But the good news is inflation expectations don't seem too far away from the Reserve Bank's target band. This is a manageable task rather than something which looks extraordinarily difficult.
And if you've been the Reserve Bank governor, would have you done anything different from what the Reserve Bank did today?
No.
You'd have done exactly that. 0.25% would have been your rate rise?
Oh, look, I probably would have done a little bit more differently, but certainly today I think when we are getting close to the end. We've had 300 points of rate hikes. Our forecast has another 50 points. I think 25s when you're getting very close to the end. I think that makes sense.
Richard Yetsenga from ANZ Bank. Always good to chat to you. Many thanks for your time today.